In Chapter 9, we investigate flexible budget variances. These variances tell us how well an organization performs in relation to its budget. The impact on profit over change in the level of activity is captured in the overall net operating income activity variance. The revenue and spending variances indicate how well revenues and costs are controlled given the actual level of activity. Regarding spending variances, we can get even more details about how well costs are controlled. In Chapter 10, Standard Costs and Variances, we will learn how to use standard costs to decompose spending variances into two parts. A part which measures how well the acquisition prices of resources are controlled, and a part which measures how efficiently those resources are used. To do that, we first need to set our standard costs. A standard is a benchmark or norm for measuring performance. In managerial accounting, there are two types of standards which are commonly used in manufacturing, service, or non-profit organizations. Quantity standards. Quantity standards specify how much of input should be used to make a product or provide a service. For example, let's say in Chick-fil-A, quantity standards are how many chicken wings should be provided in one serving. Price standards. Price standards specify how much should be paid for each unit of input. In Chick-fil-A, price standards are how much should be paid to purchase the raw chicken wings for one serving. Generally speaking, there are two categories of standards. First, ideal standards. Ideal standards can only be attained under the best of circumstances. They allow for no work interruptions, and they require employees to work at 100% peak efficiency all of the time. Second, practical standards. Practical standards are tight but attainable through reasonable, highly efficient efforts of the average workers. They allow for normal machine downtime and employee rest periods. In our real life, when setting the standard costs, practical standards are more appropriate. In this chapter, we will assume practical rather than ideal standards are in use. Now let's set standards for direct materials, direct labor, and variable manufacturing overhead. For direct materials, the standard price per unit for direct materials should reflect the final delivered cost of materials, minus any discounts taken. For example, if you always purchase materials in a large bucket and receive 20% discount, you should deduct the discount in the standard price. Standard quantity per unit for direct materials should reflect the amount of materials required for each unit of finished product, and minus allowance for unavoidable waste, spoilage, or any other normal inefficiencies. The standard quantity per unit is summarized in a bill of materials. A bill of materials is a list which shows the quantity of each type of material in a unit of finished product. Setting standards for direct labor. The standard rate per hour for direct labor includes not only wages earned, but also benefits and other labor costs. So many companies just prepare a single rate for all employees within a department, which reflects a mix of wage rates earned. The standard hours per unit reflects the labor hours required to complete one unit of a product. Standards can be determined by using available references, which estimate the time needed to produce a unit of product or perform a given task. Setting standards for variable manufacturing overhead. Let's just call it variable MO. The price standard for variable MO comes from the variable portion of the predetermined overhead rate. The quantity standard for variable MO is expressed in either direct labor hours or machine hours, depending on which one is used as allocation base in the predetermined overhead rate. This is the standard cost card for 1 unit of a product. The standard cost card is a detailed listing of the standard amounts of direct materials, direct labor, and variable MO inputs, which should go into a unit of product, multiplied by standard price or rate, which has been set for each unit. And then we can get the standard cost per unit for direct materials, direct labor, and variable MO. Add up together, we can get the total standard unit cost. In Chapter 9, we've learned a spending variance is a difference between flexible budget cost, which is how much the cost should have been given the actual level of activity, and the actual amount of the cost. Now, we can decompose spending variances into 2 types of variances: quantity variance and price variance. Quantity variance is the difference between actual quantity and standard quantity. Specifically, a quantity variance is the difference between how much of the input is actually used and how much should have been used. It's stated in dollar terms using the standard price of the input. Price variance. Price variance is the difference between actual price and standard price. Specifically, that's the difference between the actual price of the input and its standard price, multiplied by the actual amount of the input purchase. Quantity and price standards are determined separately for 2 reasons. First, different managers are normally responsible for buying and for using inputs. For example, the purchasing manager is responsible for raw materials purchase prices, but the production manager is responsible for the quantity of raw materials used. Second, the buying and using activities occur at different times. For example, raw materials purchases may be held in inventory for a period of time before being used in production. Quantity and price variances can be calculated for all 3 variable cost elements: direct materials, direct labor, and variable MO. The calculation is the same for all 3, but in different names. Say for materials, quantity variance is called quantity variance, but for labor and variable MO, that's called efficiency variance. For materials, price variance is still price variance, but for labor and variable MO, it's called rate variance. Let's take a look at the general model for variance analysis. Before we take a look at the whole picture, let's make an assumption. We assume all materials purchased in a period are used in the production process that period. Let's take a look at the general model for variance analysis. Column 1, standard quantity allowed for actual output at a standard price. This is the flexible budget cost based on the actual level of activity. Column 3, actual quantity of input at actual price. This is actual result. So the difference between flexible budget and actual results is spending variance. Now we create column 2, actual quantity of input at standard price. This is to decompose spending variance into quantity variance and price variance. Let's first explain these terms and then do the calculation. Standard quantity is the standard quantity allowed for the actual output of the period. For example, to make a cup of coffee, if the standard quantity is 2 spoons of coffee beans for each cup of coffee, and 10 cups are sold, so the total input will be 20 spoons of coffee beans. Keep in mind, standard quantity is based on actual output. Actual quantity represents the actual amount of direct materials, direct labor, and variable MO used. Standard price is the amount which should have been paid for the input used. Actual price is the amount actually paid for the input used. Now if you take a look at the whole picture of the general model, we have column 1, standard times standard. Column 2, actual times standard. Column 3, actual times actual. And we can calculate quantity variance and price variance. Learning objective 1 is to calculate the direct materials price and quantity variances and explain their significance. Let's take a look at the example. Glacier Peak Outfitters has the following direct material standard for the fiber fill in its mountain parka. 0.1 kilogram of fiber fill per parka at $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased and used to make 2,000 parkas. The materials cost a total of $1,029. Compute materials quantity and price variances. Let's apply our general model for variance analysis to this example. Column 1, we use standard quantity times standard price. Keep in mind, standard quantity is allowed for actual output. The company has purchased and used materials to make 2,000 parkas. So, actual output 2,000 parkas. We calculate standard quantity, allow for 2,000 parkas. And for each parka, 0.1 kilogram of fiber fill required. So we use 0.1 kilogram per parka multiplied by 2,000 parkas. And we can get standard quantity allowed for actual output, 200 kilograms, multiplied by standard price. Standard price for each kilogram, $5. So for column 1, 200 kilograms multiplied by $5 per kilogram, and then we can get 1,000. This is a flexible budget cost based on actual level of activity, 2,000 parkas. Column 2, actual quantity times standard price. Actual quantity. If you go back, take a look at the question. 210 kilograms of fiber fill were purchased and used. So this is actual quantity used to make 2,000 parkas. Standard price, $5 per kilogram. So we use 210 kilograms multiplied by $5, and we can get $1,050. Column 3, actual quantity times actual price. This is actual cost. If we go back, take a look at the question here. Materials cost a total of $1,029. This is the actual cost. We can just put this number on column 3. But if we want to get the details, we need to calculate actual price for each kilogram, because the question does not tell us. We know actual cost, $1,029, and actual quantity, 210 kilograms. So we can calculate actual price for each kilogram, 1,029 divided by 210, and then we can get $4.90 per kilogram. To calculate column 3, we can use actual quantity, 210 kilograms, times $4.90 per kilogram, and get actual cost, $1,029. Now we can calculate the quantity variance and price variance. The materials quantity variance, defined as the difference between the quantity of materials used in production and the quantity which should have been used according to the standard. It's $50 unfavorable. It's labeled as unfavorable because actual quantity is more than standard quantity. The materials price variance, defined as the difference between what's paid for the quantity of materials and what should have been paid according to the standard, is $21 favorable. It's favorable because the actual price is less than standard price. Keep in mind, when we determine the variance, quantity variance or price variance, we always indicate whether the amount is favorable or unfavorable. To calculate the materials quantity variance or price variance, we can also follow the equations. That's very straightforward. To calculate the materials quantity variance, we can follow the equation. Actual quantity times standard price minus standard quantity times standard price. And we put numbers here, we can get $50 unfavorable. For materials price variance, we use actual quantity times actual price minus actual quantity times standard price. And put numbers here, we can get $21 favorable. The production manager and purchasing manager are usually held responsible for the materials quantity variance and materials price variance respectively. The standard price is used to calculate quantity variance, so the production manager is not held responsible for the purchasing manager's performance. But sometimes, the materials variances are not always entirely controlled by one person or one department. For example, the purchasing manager may purchase lower quantity raw materials, which result in an unfavorable materials quantity variance for the production manager. And the production manager may schedule production in a way which requires express delivery of raw materials and result in an unfavorable materials price variance. And they may fight each other.